Most trades are lost this way. You see this market in a downtrend, so you tell yourself that on downtrends all we really need to do is to look for a supply or a resistance near the past highs, so we can basically take the market down with a sell position, because you know that on downtrends the market usually breaks previous lows into forming lower lows, and the formation of lower lows on downtrends form the so-called break of structure. You win this setup and you get confident and you tell yourself that this is easy, so you do the same once again. But this time, the market breaks above the last high, which hits your stop loss and ends you in a loss. Then you become greedy and open random trades. But instead, you could have taken a loss and continued with the analysis at least. For example, this break that took out many sellers' stop losses, it actually broke above the last high while being in a downtrend. So you skip the important part that the market has probably now reversed into an uptrend, so the selling entry models are now invalid. But this is when you have the highest chances of catching a good setup, is right after a market structure shift. The shift indicates that the trend has reversed, and after any significant break, we expect a pullback. So if we've reversed from a downtrend into an uptrend, and we expect a pullback, well then we would expect the market to form a higher low so the market can later push to the upside and break the past high. And this upside movement usually is caused from a demand zone, or a support, and in some cases from an imbalance as well. With this break of high now forming the break of structure towards the new highs, but we don't actually trade this demand or support from this time frame, and instead we wait for the price to fill the zone. Then we will actually zoom into a lower time frame and look for the same price action, basically for a break of the past high, which would form a market structure shift inside the lower time frame. This shift validating a demand or a support near the lows, and it's actually from here where we will take the position, because if we would from the higher time frame demand or support, it would be harder to manage a higher risk-reward ratio since the stop-loss zone is pretty large. So in order to compensate, we would also need to target for a larger take profit. But now on this low time frame, we can actually have a tighter stop-loss, which would also allow a tighter take profit, but with a higher risk-reward ratio. And this allows us to lose 2, 3, or even 4 trades and win just 1, and that will cover all the lost trades. So now let's see how this would work on a live market. So as usually, we first want to have a clear view of the market's trend in a higher time frame. The 1-hour time frame is a great one to start with. And here on the gold market, we're seeing a constant flow of lower highs that are followed with lower lows. A straight and simple downtrending market. Now on downtrends, the future highs do not break the past highs. And instead, it's the past lows that break into new lows. This downside break on a downtrend is called a break of structure, which is basically what is created after a lower low is formed. And usually after a break of structure, a pullback is expected, and a pullback on a high time frame downtrend is a low time frame uptrend. Uptrend that forms a lower high with a strong high, followed by a weak low that gets broken down in order to follow the downtrend, forming lower lows, therefore another bearish break of structure on this higher time frame. So once again, as I've said before, after a break of structure, some kind of pullback is often met. Pullback that forms a local high, a strong high, which is as expected once again, followed by a break of the lows into new lower lows, to eventually create the break of structure. But shortly after, the past high gets broken up. This is what it is called a market structure shift, and coming from a downtrend, this reverses this 1-hour time frame into an uptrend. So now instead of looking for selling setups, for example supplies near the past highs, resistances, imbalances. Instead of these selling setups, now we look for opportunities for buy-long setups since the market has now an increased chance of respecting another type of price action, basically respecting an uptrend formation of higher highs and higher lows. So it would not make sense to sell this high into a new swing lower low if the market has a higher chance of now forming a higher low, just to continue afterwards into a new higher high. So basically when we're coming from a downtrend and the last high breaks to the upside, we're pretty much expecting the market to form a higher low. We don't know the exact price, but what we need to know is that the market probably holds this low and will not look to break below it, because if it will, then this entire analysis will invalidate and we basically just got trapped. Case in, where we will have to have patience for the market to print more action. Moment where we repeat the analysis from scratch. But that happens more rarely, and the more complex and proper analysis, the higher the chances of it respecting. But the most we can know for now is that the market, if it would break into new highs, the bounce to the upside should happen around this price range. And the market doesn't just bounce randomly without any justification or reason. It bounces and heavily reacts because it attracts liquidity. And the simplest way of identifying liquidity is to look on the left of the price range that we believe it has a high chance of rejecting to the upside. And on this entire price range on the left, we need to identify a buy entry model to justify our view that the market rejects to the upside from a specific level. The highest quality buying entry models are as follow: demand zones, support levels, and bullish imbalances. Here, for example, we've had an imbalance. However, it was a bearish imbalance. And as you see here, it did not respect. So we kind of have a proof of concept that imbalances have not worked in this price range. So what we can look instead are demand zones. For example, here it might be a demand, but then this demand already got filled right above before forming the market structure shift, so I wouldn't say it's high quality. There is also another demand right here, also got filled on the next candles. This one was also very small, so there is larger risk of getting stopped. When facing these situations, what you can do is taking the largest recent bearish candle, considering you're taking a demand zone near the swing lows. This increases the chances of the price filling the demand since it's a larger zone. Now that it filled, we have two options. We can trade from here, but the problem in doing that is that this will not have an optimal risk-reward ratio since the zone is larger, and that means that the stop loss is wider and take profit also much wider, also making this trade last a lot longer to close. So what we can do instead is zooming into the internal price action and looking on a lower time frame for the setup. For example, this is the same price level, but just on the 1-minute time frame, so we do a quick analysis here. It's not hard to observe that the market here created a downtrend formation of lower highs and lower lows, basically having protected highs that the next highs do not break, while having lows that constantly break down into forming the bearish break of structure. And this is met here as well. Now if you notice, the market pushed to the upside, pulled back down, but then instead of breaking down into new lows, it actually has broken up into a new high, basically breaking the strong high. So this is market structure shift from a downtrend into an uptrend. And because this is on the internal price action, on the lower time frame, we call this an internal market structure shift. Now what we do here is we identify a buying entry model as close as the lowest price we can. And there is only one demand which should be around this level. This being the low time frame demand, and this is the zone from where we will actually enter with trade. We want for the market to liquidate this low, which will trap some traders into believing that this market will continue to push down. But these traders are not aware of a demand zone on the bottom, from where the market usually has a higher chance to bounce from that level. Now we're planning the setup itself. Entry on the demand, stop loss below the low time frame demand, and now the question is at what level we can look for an exit out of this setup, and for that we can zoom into a higher time frame so we can identify a couple zones there. This is just one time frame higher, being the 5 minutes chart. Now here we have, for example, right here a supply zone. However, if we exit here, the risk reward is just way too high, so we can look slightly lower. There's another supply. And this looks to be much more sustainable. Now we zoom back into the lower time frame and we follow the setup. We've got the position opened. Soon bullish momentum keeps increasing, and eventually turning into a win with a wick. Now let's see the continuation for a bit. There another wick on the take profit. And now with actual candle closures, that in case if the market did not close the orders, well now it surely did. Now on another market, here as well, we can clearly notice a downtrending market that is forming lower highs followed by lower lows. But then on the last price movement, the market pushed aggressively to the upside with increasingly large bullish candles. Before that, meaning that on the beginning of the chart, we saw how the highs were strong highs, or protected highs. And it's the lows that were breaking down into new lower lows, which eventually creates the bearish break of structure, and this entire price action pattern kept repeating for a while. Basically, up until the market started pushing to the upside, move that broke above the strong high. So just like the previous market, this is a market structure shift. Now here the difference is that it's only a small sequence of candles that caused this large upwards pressure that broke the highs. And usually when there is a candle that is much larger than the previous one, and also larger than the next one, an imbalance is met between those candles. Now we're seeing the price sitting right on the imbalance. So we basically just switch into a low time frame to look for a higher quality setup. Because if we would take a setup out from this large imbalance, it would be very hard to manage decent risk-reward ratio without having the target set too wide. Let's try the 5 minutes time frame this time. Now here we see this descending price action. That is still met on the last candles that we can see. So far, the trend expectation is a lower high followed by a lower low. That unless the market actually manages to break above the past high, but we need to see first what happens so we can react later. And yeah, basically a continuation of this downtrend. Nothing unexpected so far. Now it consolidates, and a large upwards push. Now this recent upside move breaks above the past high. So we're having formed the internal market structure shift since the break has happened in the lower time frame. So now similar to what we've met before, identifying a demand zone near the swing lows, this being the low time frame refined demand. So planning the setup now, stop loss below the lows, take profit above the recent swing highs, or we can even target higher, depending if there is a supply or an imbalance to use as an exit level. But so far here it's fine. It's right above the swing highs, while also having a good risk-reward ratio. Trade got opened, and this time we're taking a loss. The market actually broke the demand, invalidating the demand. It happens. Not all setups can be won, and actually you don't even need many winning setups as long as you properly manage your risk-reward. So if that demand is invalid, we wait for another opportunity to appear. Here, for example, we see this swing upside move, then pull back to the downside, followed by a continuation towards new highs. A break of the past high during an uptrend is a bullish break of structure. And after a break of structure that comes from an uptrend, we expect a pullback to the downside that should not break the past low, which should be then followed with a higher high. So a good level to look for a buying setup is near the lows that can form around this level. And we need to justify a buy setup with a buying entry model on the left. For example here, it is another demand zone. So we try once again with the same setup planning. Stop loss below the demand, and slightly lower because this is a smaller zone, and take profit above the recent swing highs. Or you can also go above the other highs that we can see in this chart, which would make more sense because we're targeting the extreme swing levels, basically expecting a bullish break of structure in the higher time frames. And cases like this are not met that often, and now we have patience and let the market do its thing. The entry got filled now, and this might take a while, but the bullish pressure is increasing. And the market is forming swing higher lows, so that's a great sign. And eventually it pushed into the highs, going even higher than the take profit level. Now in the case when the market initially follows an uptrend, we see a higher high with a higher low. The higher low is usually the pullback from where the market bounces up from a demand or a support. Bounce that breaks above the past highs, forming higher highs and having created the break of structure. And after a break of structure, a pullback happens. Pullback that on an uptrend is seen with a lower time frame downtrend. Move that fills another demand or another support, with traders buying to take the market higher. But this won't work forever, and the market will eventually break down below the past lows, which creates lower lows and also the market structure shift prints, moment whereas smart traders will look for a supply or a resistance in this higher time frame. But we won't sell from this level, and instead we will zoom into a lower time frame inside this high time frame supply or resistance. And here we will look for the market structure shift, which should validate another supply or resistance, level from where now we can sell short to take the market into new lower lows. This allows a higher risk-reward ratio with tight targets. Now at the time of recording, this price action did not happen, so I couldn't take this trade to show you an example, but you can find similar setups on my trading program where I have a lot of information from simple to super complex analysis. Our goal as a team is not only becoming profitable, but staying profitable is way more important because everyone can win some trades. But winning more than losing in the long term is what's the hard part. So if you're interested, feel free to check the link in the description.